Data for the US rebounded through the June quarter, and momentum has been sustained since. Still, the economic toll that the virus has taken is severe and will have a long-lasting impact. Highlighting clearly the degree of slack in the economy as a result of COVID-19, the US unemployment rate remains above the GFC peak of 10%. Total labour underutilisation is also being exaggerated by rampant underemployment. That is, when workers are unable to find enough hours to meet their needs, or more qualitatively, a job that matches their skills and experience. With household income and spending prospects impaired, the FOMC expect annual inflation to remain below their 2% inflation objective to end 2022, and to only reach the threshold sometime in the loosely defined longer run. Indeed, considering current uncertainties, the risk is that labour underutilisation remains greater and inflation weaker than forecast. It's not surprising, then, that the members of the FOMC have recently continued to stress the importance of monetary policy remaining ultra-accommodative for the foreseeable future, even if additional fiscal support is delivered by Congress. To do otherwise would prevent the FOMC meeting its inflation mandate. It is important to note that this viewpoint is not only based on current circumstance. Subpar inflation has been a persistent theme in the US ever since the GFC. Highlighting this, the 5- and 10-year averages of annual core PCE inflation to June 2020 are just 1.6%. The averages for the headline measure are weaker still, around 1.5%. Even in 2019, when unemployment and underemployment were historically low, core PCE inflation averages 1.7%. Now, with a mild economic slack, the risk is not of a mild disappointment on inflation, but rather of a hefty and entrenched deviation from target, which could easily suppress wage growth and spending by households and businesses over the long term. Cue FOMC Chair Jerome Powell. At a virtual Jackson Hole symposium, Chair Powell announced that the FOMC had unanimously agreed to adopt a new framework for monetary policy. Maximum employment and 2% inflation over the medium term remain the FOMC's mandate. But the difficulties in assessing progress towards these objectives in real time and risks to the outlook now have much greater prominence. The consequence is that the committee will seek to achieve inflation that averages 2% over time, with a view to minimise shortfalls in employment from its maximum level. Arguably, instead of seeing inflation at or moderately above the 2% target as a threat to the economy, they now view it as a benchmark of success in fostering a strong labour market that aids household spending and promotes capacity expansion and productivity enhancement by business. In effect, the long-term welfare of the US economy. Practically speaking, the change in perspective by the committee will see the federal funds rate and term interest rates kept lower for longer, particularly in light of the US's experience with inflation over the last decade. All else equal, this change should also see the US dollar lose ground against other currencies like the Australian dollar, and further support recovery in risk assets such as equities and commodities. If economic conditions disappoint or deteriorate again, it also guarantees the FOMC will be quick to respond with additional easing. Arguably, only if financial stability is threatened will they see cause to tighten policy, absent a sustained above-target inflation period, which proves maximum employment has been achieved. We'll see you next week.